Perhaps you're an investor with an optimistic opinion on a stock, index, or ETF. If you're looking for a way to invest with less money at risk, consider using the long call option. So, what's a long call? The term long is the same as ownership, meaning you bought something. So if you own XYZ stock, then you're long XYZ. In the same way, if you're long a call option, you own it. However, when buying a call option, you don't own the stock, but rather you own the right to buy the stock at a specific price, known as the strike price. And it's this right that contains your limited risk and unlimited potential profit. With a long call, you profit when the call goes up in value, and that typically happens when the underlying stock, index, or ETF goes up in value. If the value of the underlying decreases, then the call option drops in value. One of the benefits of the long call is the limited amount of money that needs to be at risk versus buying stocks or ETFs themselves, while still having no cap on the upside. A couple of things to keep in mind here. First, since you've merely bought the right to buy a stock, there's nothing that says you actually have to buy it. Second, even though you can buy the stock at, say, $50, the primary goal of buying a call is to benefit on the increase of the value of the call. So you're likely to just sell the option at some point for a profit before it expires. Let's look at an example of a long call. Let's say XYZ stock is at $49. Instead of buying the stock at $49 per share, you buy a 120-day call option with a $50 strike price for $2.80, or $280 per contract since each call option represents 100 shares of stock. The strike price is the price at which you have the right to buy the stock. What happens next? Now suppose the stock moves up from $49 to $54 in just a couple of weeks. With the stock up about 10% over this time, your call option has nearly doubled in value to $5.50, and your profit is $2.70 or $270 per contract. If the stock were to keep moving higher, typically the value of the call option moves higher as well. But because there is time left before the call expires, the increase is not dollar for dollar with the underlying stock. Remember that you can sell your call option any time before the expiration date. Again, prior to expiration, when there is still time, the stock moving lower doesn't necessarily mean you have a complete loss. The option only loses some of the premium, but not all. How much depends on how much the stock drops and how much time there is left to expiration. And don't forget, you have the right to sell the option any time before the expiration date. Now, if at expiration the stock finishes at $54, the option would be worth the difference between the stock price and the strike price. In this case, $4. Since you paid $2.80 for the call, your profit is $1.20 or $120 per contract. Only at expiration would the option be worthless if the stock price were equal to or lower than the strike price of $50. The good news is the most you can lose is the $2.80 or $280 per call option versus $49 per share had you bought the stock. So the maximum loss is always what you paid for the option.